How do I know if my case will benefit from credit damage measurement?
An allegation of credit damage is a very serious matter. Credit damages can easily and readily increase the value of a case by 5 or 6 figures. In one case, 7 figures. So if there's an allegation or inclusion of credit damage in a complaint, it might be a good idea for you to immediately contact a credit damage expert.
What can credit damage measurement do for me?
There are 3 essential areas where a credit damage expert will be an important member of your expert team. The credit damage expert will help you with the proper procedures regarding appropriate discovery questions and requests within the confines of the Fair Credit Reporting Act and not helping the other side to get more money. The expert will help you frame the questions so that you are not helping the other side increase the value of the case. It is common for the plaintiff's lawyer not to fully understand how to establish a proper credit damage measurement report. Also, the expert will provide an evaluation of the validity of the plaintiff's demands regarding credit damage measurement. The more vague, the better for defense. And overwhelmingly, plaintiff's lawyers do not know how to specify or lay a proper foundation for a credit damage valuation demand. That's where the expert will help you.
What can credit damage measurement do for me?
It's most helpful if you talk to someone whose knowledge is specific to this subject. It is crucial for you to understand the differences between a credit damage measurement expert and someone who can only address part of the entire credit damage scope. An individual who has a background in mortgage lending will limit their expertise and their testimony to a mortgage issue. A person who has an accounting background will address different issues than the real estate expert. A insurance expert regarding 401ks and liquidity will only limit their expertise to that topic. For a comprehensive overview of all the 6 factors that are typical in a credit damage claim or demand, the credit damage expert is the only one able to look at all of those facets rather than just one. This is also true of an economist. An economist cannot look at all the factors that a credit damage expert would look at. So the scope of their service is very different.
How many credit damage experts are there? Who else can I talk to?
There are 3 kinds of damage that may be claimed or included in a damage demand by the plaintiff. Those include increased out-of-pocket costs, loss of credit accounts, and loss of credit expectancy. It is typical for only 2 of those 3 to be valid within one case. It's not impossible for all 3 to be valid, but typically 2 is the maximum without duplicating the damages, double dipping for the same value.
What is loss of credit capacity?
Loss of credit capacity. Let's talk about that. Loss of credit capacity has several aspects of it to be considered. The first is accounts are canceled. That is as much an extreme example of loss of credit capacity as any. There's also that the account is not canceled, that the credit limit on the account is lowered, and typically the limit on the account equals the balance that's owed on that account. So while it is technically active, there are no more charge privileges on that card. There is also the loss of the ability to refinance. That's a loss of capacity. And one of the other factors involved with loss of capacity is if the interest rates to an individual are increased, that typically will have the ripple effect of lowering the amount of credit that is affordable. If the interest rate on a loan goes from X% to Y%, and as a result, the interest payment goes up by 20 or 30 or 40%, as it is not uncommon in adjustable rate mortgages, all of a sudden that credit account is no longer affordable at the capacity. Now that's what you want to think about with loss of credit capacity.
What is loss of credit expectancy?
Loss of credit expectancy is a type of damage in which the future of an individual's or a business's credit is at stake. Pre-injury credit is the baseline and is the documentation of credit that has been developed and has been extended to the plaintiff. That is the result of conscientious or not credit payments, and a reputation has been developed, and based on that reputation the borrower has an expectancy of being able to get the kind of credit at typical rates similar to what they had before. If they were an A-rated borrower before, then they expect to be an A-rated borrower after, because they have developed that lifestyle, that financial style. When that is removed, when the credit applications are denied outright, or the credit applications come back with higher than rates and charges and an increased deposit, then the expectancy has been damaged and in the extreme lost entirely. Lost entirely, of course, is denial, total denial of the credit. And if you go from having credit to not being able to get credit, you are experiencing loss of credit expectancy.
What are increased out-of-pocket costs?
Consider a mortgage that cannot be refinanced. Even though the borrower would qualify at other factors, but because of the damage caused, refinance is impossible. That will increase the out-of-pocket costs, which will be met. That will not be the damage. The payments will be met, but a payment that hypothetically was $1,000 a month because of the original contract cannot be refinanced for a lower payment of any number, but let's say $600 or $700 to take advantage of adjustment in interest rates. So the denial of that refinance becomes an increased out-of-pocket cost. There's also insurance factors, depending on your credit report and the state that you're in. Money, prepaid, works just fine. Contact my office, give me your email address, and let me know whether you're plaintiff or defense. Let me know who the client is and who the other side is, and we only need that information for conflict check. Prior to that, I don't want any information on the case until you've retained me. All fees and terms are clearly set forth in the retainer agreement. That is the basis of our relationship. All funds must be paid in prior to delivery of the final opinion, whether verbal or written, and all funds are non-refundable.